Welcome to This Week in Money. I'm Jim Goddard. Today, Morgan Report founder David Morgan tells us why he's optimistic about gold and silver. Eric Coffin from the Hard Rock Advisors comments on low gold prices despite record demand. And should you let emotions rule your investments? Tim Cyclesman Wood takes a stand on that. We talk to David Morgan right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is David Morgan, founder of the Morgan Report, which you can find online at silver-investor.com. He's speaking to us from Spokane, Washington. Welcome to This Week in Money, David.
Thank you, Jim. Great to be with you.
Maybe explain to people what the Morgan Report's all about.
Well, the subtitle is Money, Metals, and Mining. And we take the, big picture down. The big picture is, what is money versus currency? And that's a pretty big question, actually. Most people don't really ever think about it. They assume because they've been brought up in what I call the matrix or the banking cabal paradigm, that this piece of paper that they print for basically free has value. And that paradigm has been tried over and over again. This is certainly not the first time in history that that's taken place. But most people never really think about it. They have, even, the atheists or the agnostics, so they don't have any faith, but they have faith in that piece of paper. And really, that piece of paper is nothing more than that eventually. And that's the money part. I don't want to dwell on it, but then money, metals. We look at most of the metals, really. We look at the base metals, some of the rare earths, some of the strategic, but primarily focus on the precious metals and the top four: gold, silver, platinum, palladium. But we certainly have looked at all the metals over time. In fact, we did a special report on zinc not that long ago that, believe it or not, zinc is going to be in short supply in the not too distant future. And then on the mining side, that is broader based than just silver mining companies, which of course we have several in, what we have suggested over the years, silver and gold, but over the years we've also suggested moly, lithium, copper, some of the rare earths, back in the day, before that sector seemed to, get a little overzealous. Uranium company here and there. So we look at basically the resource spectrum, but it's important to know that we focus most of our attention on the precious metals, gold and silver.
And how could somebody get a subscription to it?
It's very easy that you can get a subscription online. It's an online business, and it's at the website silver-investor.com. There's three different levels of service. There's the basic, which is basically a buy and hold investor. Then there's your basic plus, which gets everything that the basic member gets, which is, access to the protected part of the website with all kinds of extra material besides the newsletter. And they also get the videos that we do, which entail some of the mining trips that David Smith and Chris Marchese go on. Occasionally I go on them, and then film the trip. And then there's also videos of conferences like the one we just finished here in Spokane, the Silver Summit, where we interview almost every company that was there, many of the speakers, a lot of couple of speculative type situations. And so that is the basic plus. In addition to those videos, there's the ones that I make from time to time on an as required basis as far as how the market is doing. And those, because the market changes so much, I don't like to do them daily or weekly even. I don't want people to get in the habit of, every Friday at noon he's going to do one. I basically take the time to let the market tell me really what or when. Although I certainly listen to the subscriber base, and oftentimes they'll say, hey, it's time to do an update, or what do you think of this? And that'll prompt me to do one or another one or that type of thing. And that's where I take the charts, and it's not always just charts, but mostly it is. And I look at, the bond market, the stock market, the dollar market, the gold and euros, the silver market, platinum, maybe the ratio, silver-gold ratio. I mean, lots of things. There's no really set, oh, it's going to be this, although primarily we look at how the overall trends are doing in the precious metals. But we've looked at specific companies, looked at the HUI, the XU, and it goes on and on. So that is all part of the Basic Plus service, and that's the most popular service. A lot of newsletter types charge in the range of 1,000 to 5,000 for that type of service. We charge somewhere like 300, or it's even less if you pay a year in advance. And then there's one other level that I won't explain much. It's called the mastermind, and that's basically for high net worth individuals or fund managers that have a lot of money devoted to this sector, and they want our very best thinking. They want to basically be able to be with us on a conference call with some of the better known names and personalities in the market, like Eric Sprott, Mike Maloney. We're having one coming up with Foster Gamble, who produced the movie Thrive. He's got some very interesting things to say about the current situation in the monetary system, and we'll be drilling down with him. And I'm probably going to open that up to more than the mastermind people. I'm probably going to be giving a holiday gift to all the people that supported us and try to reward them for their loyalty to us, because, that's what it's all about. My belief system, I've always felt strongly that it's not what you get out of life, it's what you give to life. But obviously I need to make a living like everybody else. So this is something that we're working on right now. We think we have a confirmation from them, from the Thrive people, or Foster Gamble in particular, and we'll be able to offer that next month. So thanks for letting me drill on, but I haven't done that in a long time, explaining basically what the Morgan Report is and the 3 different levels of service that we have. So thank you, Jim.
Well, thank you for explaining it. David, people want to know, have we seen the bottom on the precious metals market?
Hard to know just yet. Certainly you could argue that we have. Silver particularly looks like a V bottom, but it's really just too darn early to know for sure. But assuming that it is, there's a couple ways to know, and almost ahead of time, really. One is what happens around the $17 level. If we penetrate that to the upside on large volume, and it stays up above that level for like 2 or 3 days in a row, then we have a very strong probability, not a guarantee, but a strong probability, like 80, 85%, that we're going to go higher and the bottom is in. Conversely, if we get to that area, and of course it could be below that area, it's nothing magic, but that's the first level of congestion after we made this quote-unquote bottom, which we're going to determine here not too far from now. And if it gets into congestion there and it falls back down, then there's a strong probability that will test that $15 level, whatever it was, I forget the exact number, and see if it holds or not. So there's 2 ways to go. I mean, it's a tough call, because most people are so, worn out. I mean, I coined the phrase, this market will scare you out or wear you out. And we're definitely in a wear you out. I mean, it's been 4 years for the silver market and 3+ in the gold market. So it's worn out a lot of people. And then after it's worn them out, some of these sharp drops that we've experienced recently have scared people as well. They scared the worn out people. So that's where we're at. I think we're probably about there, or perhaps there. We don't know yet. But I don't really think, and I'm not of the belief system, and it's not because I have some fascination with the metals and I have to be right or any of that kind of thing. It's because the market and the sentiment are so bad right now, and the duration. It's been 4 years, and I said it would be 2 or 3. It's been longer than that. So we're at a point, I think, for lots of indicators that we use. The valuation of the dollar, the valuation of the SPX, the sentiment in the gold markets, what's going on kind of behind the scenes, although the gold bugs are well aware of the Swiss referendum, et cetera, that we probably are within a cat's whisker of the bottom, or perhaps, as I say, behind us. So what's happened the last few years is that the paper paradigm that controls the price, at least at this point in time still, has moved the market down to basically the last trading day available for the metals. And that is a likely scenario. But again, we don't know. We have to just watch kind of day by day. And, the $1,200 level is critical for gold. So they're certainly looking okay, but, nothing that I'm getting real excited about. Palladium has been the leader for quite some time and set a new high. It got up to like $901, and then in the sell-off, it got crushed along with the other precious metals. Today, it's up about 20, and platinum's up 22. And palladium's something to watch. It's kind of a good indicator to see, which way these metals are going. It's the leader today. So we may be there. It's just, again, I know I keep repeating myself, but it's not as easy to pick these things. I mean, I've been good. I picked, most of the tops pretty accurately. Bottoms are tougher for me. Yet, I'm pretty optimistic. What I want to state and make very, very clear is that this is not, in my strong studied view, going on another year or another 2 years or whatever. And that's contradictory to some of my peers that I respect a great deal, such as Dr. Michael Berry, who was at the Silver Summit, invited guest, and he and I have a strong personal and professional relationship. But he basically stated that, we've got a couple more years of this deflationary, deleveraging scenario, and just be prepared that, this market's going to grind sideways or lower for years longer. I totally disagree with that. I think that we are, on the cusp of starting, maybe going sideways, but sideways to higher, and that type of thing. Not sideways and down further, or just sideways for 2 years. We are going to start to climb out of this.
What's the basis for your optimism?
Well, one is being a contrarian to the contrarians. I mean, the sentiment is so low, and based on a lot of indicators that I see on the sentiment side, that's one reason. Another reason is the way silver's reacted on the chart, but that's an art, not a science. The other thing is what's going on in the physical market. I mean, what you see, what's happening with the Eagle market, the U.S. minted 1 ounce silver coins. They've been inundated with orders that can't keep up. The second thing is what is going on in the large wholesale market, and the dealers that I know of pretty much on a first name basis. And they are basically behind the order curve. They have people coming in demanding bars and coins and rounds and, silver retail products, and they're taking their orders, but they're backlogged. In other words, they don't have product in their hands to put over the counter to give to these people that are buying. They're locking them in on price, but they have to wait for product. That's on the retail side, and that doesn't necessarily mean the entire silver market, but it's a pretty good indicator. One of the last that I haven't talked about in a long time, which has been a very, very good indicator, is what the bag market is doing. When the silver bag market, or what's known as junk silver, I don't like the term, but that's how it's referred, the junk bag market is at a premium. And whenever the bag market is at a premium, that's a pretty good indicator that we're going higher, and we are. So lots of things, does that make it absolute? No, it doesn't. But all the indicators that I watch certainly suggest that things are going to go up here. And that's, pretty quick.
Do you expect the inverse relationship between gold and the U.S. dollar to continue?
For a while, but I'm not of the belief, having gone through the first bull market and studied these markets for so long, that it's exactly an inverse relationship. In fact, you're starting to see gold go up as the dollar's going up. It's not always inverse. And so gold's starting to act like a currency, or really money amongst currencies. And what you can see by this, if you're, looking at it carefully, is that gold is starting to compete in the quote-unquote monetary realm, where it's the preferred money of choice versus the other currencies. So you can see a currency such as the dollar go up and gold go up at the same time. It is not always an inverse relationship. In fact, I spoke about this not that long ago. I don't know, it's been probably 6 weeks, about the extra upside-down pyramid, and I saw that after I had spoken about it, that a lot of my peers also talked about it, and that's fine. It's certainly not my work. It's John Exter's work, for crying out loud. I want to give him full credit for it. But what the upside-down pyramid shows is that the biggest place to see strength before the massive run to gold starts is the dollar. So it's not unexpected by me and others that the safety place to be is dollars, U.S. dollars, until faith starts to wane in those. And that's when the move starts starts out of dollars and into gold, or what Trace Mayer refers to as the Run to Gold, which is a great website, by the way. And that is why I'm not all this worried about the dollar index going higher and higher. It's really what you would expect before you see this, run to gold. Well, gold's starting to move up while the dollar's moving up. Again, it's a subtle clue, just like platinum and palladium is a subtle clue to what's going on with the metals markets. But nonetheless, the clue's there, and it pays to pay attention, which means if you really, look at this objectively, you do get these indicators that can give you some level of confidence that you can, not only do your own work, which I do, certainly listen to others, but you don't have to follow them, and see for yourself which way these markets are going to move. So probably enough said on that topic, but thanks for the question, because it's one that everybody wants to know, and it's one that even the faithful have pretty much lost faith. But I don't, again, think we have much longer to worry about it.
Are mines being closed because of low metal prices?
To my knowledge, at this point in time, I don't know of any of the mid-tier to top-tier companies that have really closed, but we're probably getting close. I know there's like projects that are put on hold, or projects that were, have a preliminary economic assessment completed, and going back a year or two, they were ready to start putting it into production and that type of thing. I mean, Holdra, which was a speculative company that we follow closely, was one that was ready to go into production, and I can't remember how many months ago it was. I'll just shoot out roughly a year ago. And in fact, we just talked to the company, at that time, and everything was a go. And prices were soft, but not as soft as they are now. And basically they pulled the plug. They said, no, we're not going to do it. So that's one specific one that never went into production, that was slated to go into production. But at this time, again, I can't follow 4,000 companies. I don't know of anybody in the business that can. I think John Kaiser is probably the one that can follow almost all of them. But nonetheless, we follow more of the top tier and mid tier, and speculate somewhat, but that's not our forte. Our forte is making money with cash rich, unhedged, long-term type of mining situations with pretty good growth profile. Nonetheless, there's none that I can recall off the top of my head that are going closing, but it's something to bear in mind, because if I am wrong and this thing is going to go for 2 more years, as Dr. Berry suggests, then obviously you are going to have a lot of gold and silver mines that will have to go on care and maintenance, because they just will not be able to make a profit. And they'll have to make a decision. It's the best decision they can make is to drone on for a few months losing money, because it's actually in the long term better to do that and lose money for a few quarters than to shut down. Because once they shut down, it's very expensive to come back up. So it's a trade-off study that has to be accomplished by the company itself, and they have to make a determination of how far, how long they're willing to go at a loss until they decide it's more beneficial to the shareholders to put on hold. But we're so close to that area right now. Again, I think that that too is one of the indicators that this can't go another couple of years. I just don't see it. But could I be wrong? Of course.
And of course, we're nearer to tax season too, where write-offs become popular.
That's why it's such a tough call going into the end of the year. Are we going to get a rally from now? No one expects it, or I should say no one, very few expect it. I try to stay open-minded and don't rule it out, but I think the probability is more that we'll get, as you suggest, tax loss selling, and probably some selling in the futures markets, and then the paper pushers will jump on top of that and force the market even lower. I mean, that's what has happened the last several years, so it's more likely to see that scenario than the other one. But again, you never know. There's so many rumors around the December delivery dates this year. I mean, I can't remember any time in the business where we've had so many commentators talking about what's going to take place at the end of the year this year. And then you've got the reality, regardless of what these commentators say, right, wrong, or indifferent. And I'm not going to comment on that because I don't know the intimate details of some of these, contracts or, over-the-counter derivatives or any of that. I know what they are, but I don't know the intimate details. But what we do know is that the Swiss referendum is coming up a weekend from this one. And that could have a very big psychological impact on the gold market, or precious metals, really. So, that is a reality. That's something we're absolutely certain about. And that's coming at the end of the year as well. So there's lots of reasons to say, boy, this is a tough one to figure out, tougher than probably some other, time frame.
Do you think silver will top $50 an ounce, and any idea when that might happen?
Well, I think it will. I mean, I'm on record putting it in black and white. It's in a printed book, the first book I wrote, that I thought we would see, $100 silver in this bull market. So obviously we've got to get back to 50 and then go above that. I believe we will. I'm looking for, what the Elliott wave people call the fifth wave up. We've had a 1, a 2, one wave is a bull run, and then a 2 is a correction, and a 3 is a bull run, and then 4 is a correction. And then the fifth wave is the one that really, really goes. And I think we're on the cusp, again, of starting that here fairly shortly. And that's the one where you get massive public participation. And so there could be a synergistic effect where there's people that want out of the dollar because, they realize that China and Russia are the BRICS countries have set up a lot of counter dollar availability to the financial system, where they have their own clearing system, they have their own banking system, they have their own, bond system or debt system, they have their own rating system, and they're the ones that are giving good yields, whereas the Anglo-American empire has got this zero interest rate policy that they seem set on and doesn't look like they're ever going to end it. So there's competition to the dollar, not only in currencies, but in the precious metals as well. So I think that could determine things going forward, because people will start to wake up and see there's opportunity out there, which means they're going to evaluate this thing. And once they see others doing it, that could build momentum rather quickly.
Are there certain technical markers you're looking for, or have we already discussed some of them?
Yeah, pretty much. I mean, I get criticized for, picking a year-end price and being wrong. And certainly, you could take shots at me as much as you want. I'm pretty much used to it. But those things I look at as wags. I mean, wild, blank guesses. If you're really serious, you would want to see what I do on a more detailed basis, which is for, the members only. And that's where I, go move and correct. Last year, for example, I forget when, but near the end of maybe the fourth quarter, I was, asked whether I saw silver prices by the end of the year. I said 26 for a radio show like yours, Jim, and then one of my members wrote me and said, do you still see 26? I said, absolutely not. So I made one of those videos, and I showed them the reasons why there was no way it was going to go to 26. So, people that want our best thinking had, the availability of what I saw, later on, if you want to say it, and why that was inaccurate. And I didn't do it to be cute or funny or to mess with anybody. I mean, when I said 26 on a radio show, it wasn't like I was just making it up. I felt at that point in time it was pretty likely. But as time wore on, I can't go back in time and say, Jim, I'd like to make a correction to what I said a month ago. Could you put this out for everybody that's listened to my interview? That can't be done. So, but what I can do is for people that are, in the protected part of the website, because they really do want to stay in tune with this, they can tune in, which means they get, the most recent thinking and why. So I obviously made that correction you want to call it that, to the people that really, were the most interested, at least the ones that I feel are the most interested. And those are the people that, I have a very strong relationship with.
What was the overall mood at the Silver Summit in Spokane recently?
Well, it's difficult to describe. It was not solemn, but it was serious. But, there was a little bit of levity. I mean, there was some, jokes and laughter, but it was fairly solemn. I mean, it was serious. What I found interesting was that everyone there, to a man and woman, in my opinion, was very, very astute as far as why they're in this market still. And I got feedback from about I got feedback from almost all of the companies, but three in particular that told me basically the same thing, and it went like this. These people are the smartest people at any show I've ever done. They ask the most in-depth questions, and once that's asked, they have another equally in-depth question. And it really, is a job to go in and answer these people's questions because they're so familiar with our company and what we're doing and why we're doing it and what our next project is and on like that. So that, of course, is very gratifying for me to hear. On the company side, a few of them indicated to me, and I certainly have to, acknowledge that they, from their perspective, it makes sense. They said if it's, this slow, a year from now, we doubt we'll be back to the summit. And I can't blame them because there really was not, much foot traffic for these companies. And that's, why they come there. So, again, an indicator that, we're probably near the bottom, but not a guarantee. So it was good overall. I think everyone that came was glad that they did, including the, the companies themselves. Wasn't like the heyday, when silver was moving from, the $19 to the $48 level or anything like that. But nonetheless, it was, sparsely attended, but attended by very, very solid, in-depth, reasoned people that are dedicated to the sector because the fundamental fact for why they invested in the precious metals has not gone away, and they know that.
Just a reminder, you can get your free trial subscription for the Morgan Report at themorganreport.com. David, thanks a lot for being on This Week in Money.
Jim, it's been my pleasure. Thank you.
Coming up next, Eric Coffin on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Eric Coffin, publisher and editor of the Hard Rock Advisors Advisory.com. Welcome to This Week in Money, Eric.
Thanks for having me again, Jim.
Maybe just start off the interview, explain a little bit about the Hard Rock Advisors.
Well, my late brother and I started publishing the HRA Advisory, which is Hard Rock Analyst, basically, back in 95, which wasn't actually the best timing. It seemed like a good idea at the time because it was a raging bull market, which of course turned into a bear market almost immediately. But we managed to get through a couple of cycles. We both have an industry background. My brother went to Haileybury School of Mines. I did a finance degree. And basically, I continued the newsletter after my brother passed away a couple of years ago. But I look for companies where I see either potential growth from mine startup and earnings growth. There's some of those, but usually more often the space I deal with is discovery stories and companies with new discoveries that can grow their assets, that can make that discovery bigger and get the market to pay attention and re-rank the stock because of that.
With problems raising money in the junior markets, how has that affected exploration in Canada?
It's been pretty difficult. I mean, to be honest, I look at the numbers that the industry puts out, and they seem way too optimistic to me. I personally think the drop in exploration spending has been quite a bit more severe, and those surveys look pretty bad, but I think it's actually a lot worse even than the surveys because they tend to count they count things as exploration, like, if Goldcorp is spending $10 million drilling to upgrade reserves inside a mine, that tends to get counted as exploration, whereas when I think of exploration, I think of companies that are earlier stage working on new things, and at that level, money's been extremely difficult to come by. A lot of the companies on my list, fortunately, have fairly good bank accounts, and that's something you got to money, but, by and large, it's very tough right now. So you really got to look at whether the companies you're interested in, not just are the projects good, but can the company actually get the money to do anything with them?
Some analysts are expecting a lot more mergers to take place. Do you see that happening?
I think you'll see some. I mean, there actually were a couple of companies on my list that announced mergers just recently. Virginia Mines being one of them, merging with a Cisco, and they're essentially creating a royalty company. But I know there's a lot of companies talking to each other right now. It's tricky. It's tricky on both sides, really. I mean, the smaller companies, part of them just wants to sort of get the pain over with. But really, the prices that they're trading at right now, a lot of them are actually afraid of being approached by a merger partner because they're afraid they're going to be selling out at the bottom. But the same thing's actually true on the other side. I mean, the producers have seen their shares get decimated too, and that's made it tougher for their boards to agree to mergers because they feel like they're giving up too much dilution to take something over. But I think if we see much more movement on the gold price in particular, I think we're at the point where there's a bunch of guys that have been reviewing a lot of things over the past year as things just get worse and worse, and I expect to see more guys pull the trigger here in the next 3 to 6 months. If this gold move that we're seeing right now continues, I think there will be a bunch more activity, probably fairly quickly.
One analyst told me they expected when gold prices start to go up, it's not going to be a gradual rise. It's going to be in sudden increments and quite large ones. Do you think that's the case? That'd
be nice. I'm not sure. I don't see any particular reason to assume it's going to be, fast. I mean, I guess you could sort of say that the move we've seen so far, we're about $70 off the bottom, was relatively quick, really. It's less than 2 weeks. I think that there's probably some areas just above us here on the other side of 1200, say 1215 and around there, 1220. I think a lot of people went short in those areas, and there is potential with a hard enough push that if you get through those levels, you'll see fairly large amounts of short covering. And if you look at the gold market the last 2 weeks, the volumes are actually quite high. And that does give you the potential for, I'm not sure what that guy's definition of large was, but for, 20 or 30 or $40 even one-day moves. That can happen in this kind of scenario as long as there's enough buying to push through those buy stop levels, because I think there's a lot of buy stops set up. And I would think now with gold moving this much, it's moved a little bit in the last couple of days, even with the U.S. dollar index going up. If I was short, not very far above this level, I'd be getting pretty nervous right now.
At what point do you see the price of gold encouraging people to start investing in the juniors again?
I think we've got to get back. I think we've got to get back closer to 1,300. There is some money coming in. You will see, for Canadian projects, you'll see some flow through come in, I think, next month. But to really drive larger amounts, I think we need to see an uptrend that's got enough longevity, 2-3 months at least, I would think. It doesn't have to be up every day, but you've got just a definitive, it's not a downtrend anymore, it's an uptrend. Traders see a couple of guys pull good discovery holes and get rewarded for it. That combination is usually what really brings the money in, and it'll take I would think at least 2-3 months for that to happen. And if we've got an uptrend, we should be, I'm hoping on the other side of 1250, closer to 1300 by that point.
Have recent events helped change the outlook on gold? You have the U.S. making big noises, sanctions against Russia because of the situation in Ukraine, Japan and China making noises about those islands in the China Sea. Any of those conflicts you see turning into something that's really going to promote gold?
Well, I hope not for everyone's sake. The Ukraine I think is helping the gold price, but it's in a somewhat unusual way. Because of the sanctions against Russia, it's boxed Putin and a lot of his fellow travelers in a little bit. It's been a lot more difficult for them to borrow wherever they want to. There's a lot of financial markets that are effectively closed to them right now because of sanctions. Not surprisingly, Putin's not happy about this, and there have been rumors for a couple of months that he's been in the gold market as a buyer, and I mean he in the royal sense. He's got the Bank Rosoya doing it, the national bank there. Those rumors were largely confirmed last week when the quarterly report from the World Gold Council came out, and indeed Russia's central bank is the largest buyer this year, about 150 tons. I wouldn't be surprised to see that continue, and he's doing that in part he's trying as much as he can to basically get U.S. dollars out of the Russian system. Partially he's doing it for ego reasons, like he's ticked off at the States, and he's trying to get people to basically move to his side of the table. So he's trying to flush U.S. dollars out of the system, and part of the way he's doing that is, one, buying gold, turning the foreign currency reserves, which are still fairly sizable at the Bank of Russia, into euros and gold and yen. He's been trying to do deals, and he's had success in some cases, where large buyers of Russian oil and gas are now agreeing to pay in euros or paying rubles. He's trying to basically get people off of the dollar. I mean, I think he's doing it more for ego reasons than economic ones, if you will. But from our point of view, it doesn't really matter if he's going to get the Russian central bank to go into the market and buy a few hundred tons. It's going to help the gold price, whatever his reasons.
And China, of course, has been on a gold buying blitz for the last several years. Do you see any end to that?
There doesn't seem to be, and this is one thing I would bring up. A guy that I don't know him personally, but a few of my friends in the business, there's a guy out of the Netherlands by the name of Koos Jansen, and he has I think most of his stuff is on a website called Bullion Star now, but he basically goes and looks at withdrawals from the Shanghai Gold Exchange. He's not looking at the Hong Kong statistics, which is what the World Gold Council does. He's looking directly at the Shanghai gold market, because the way that the market works in China, the only way for you to get gold wholesale or retail is you've got to buy it in the Shanghai market. So if you look at those withdrawals, when you look at those numbers, gold demand is off slightly from last year, which was a record by a huge margin in China, but only slightly, down a few percent, and demand's been quite strong. In this run we've seen the last couple of weeks, there have been comments from a lot of the traders in London and in New York saying, there's a lot of physical demand coming from somewhere. The other place we're actually seeing a lot of it right now is India. India's demand has picked up hugely in the last month or two. I mean, they're very smart buyers. They wait for the market to drop. They want to pay the best price, which in their case, of course, is the lowest price. And there has been a very big surge in demand in India. The only caveat I would put on the Indian demand is if it gets too strong, I think as people who trade the gold market, we have to be realistic and realize that if it gets too strong over there, there is some potential that the politicians in India would raise the tariffs again, because all this gold buying isn't doing their current accounting good.
Of course, every time they raise the tariffs, it increases gold smuggling. Then the government doesn't get any piece of the pie.
Well, I'm not sure that it changed. At the end of the day, I don't know that it changes the demand that much, because you're right. What happens is it just goes underground. It just becomes smuggling rather than direct importing through normal channels, and they don't get anything out of it. And based on volumes in the physical markets, I suspect the gold demand in India, officially it fell off a cliff after they put tariffs up. But I don't think it really dropped that much. It just went to smugglers instead, which I don't think is really in anybody's interest. But it's in that situation, the problem is there's no way to really monitor it as someone watching the gold market. There's nothing you can get your arms around in terms of saying, well, this is what the demand is, because it's all underground.
Switzerland at the end of the month is holding a referendum on whether they should return to the gold standard, back their currency by 20% perhaps with gold. Is that going to have a big impact on the gold market?
If they pass that referendum, and I would say the odds are probably not very high that it's going to happen. It's not easy to get a referendum passed in Switzerland. You need 51% of the vote, but you also need to win the vote in over 50% of the individual cantons in Switzerland. So you really need very, very broad-based support in order to get a win in those. And the Swiss, they're very big on and very proud of their record for direct democracy. Referendums are quite common in Switzerland. Every election there has half a dozen of them, and they take them pretty seriously. I mean, you're not going to get the kind of goofy referendums that you see in Canada sometimes that never have a prayer. Stuff like that doesn't even get on the ballot. So the fact it's there means they got 100,000 signatures. But the last couple of polls I've seen, the no side, and in the case of Switzerland, the no side is basically the bankers, the central bank, and the politicians. It's really the little guy that wants to see this happen. I've seen a couple of recent drops in the gold market seem to have been based on poll results that show that referendum isn't likely to pass. I'm personally quite happy to see that, because I don't want to see that sort of, I don't want to see that baked into the market before the referendum, because I don't think it will pass. If it does pass, I think the impact can actually be quite large, because in order to get to that 20%, in the specified time period, they'll have to be in the market for 300 or 400 tons a year for the next 4 years, which is a significant amount of buying. I think if it's not baked in, and I don't think it is too much, and they actually won that referendum, I'd be pretty shocked if gold wasn't up $50 the next day.
Do you see quantitative easing becoming a permanent program around the world? The U.S. announces theirs is over, then Japan steps in with one. Do you think they're going to just do this in rotation endlessly?
It feels that way. You're starting to see it in Europe as well. I mean, the ECB has announced yesterday, I think, that they've started buying asset-backed bonds, which is essentially that's QE and drag is what it is. It's the same thing. China, I don't know whether China's going to go as far as QE, and they probably don't have to, really. What you may see is more interest rate cuts. They did cut rates last night, and that was for the first time in a couple of years. And that's really that's part of the reason why you saw a bounce in the gold price, and in fact a bounce in just about all commodities, since China, of course, is the elephant in the room when it comes to all of this stuff. And if they've decided to open the taps again and try to stimulate their economy, it's likely to help all of this stuff, including the gold price. I think you may see more of that. I think their economy's slowing a little faster than they wanted. I think they're getting a bit alarmed about it. It's a bit trickier in Europe. Personally, I think what Europe really needs isn't so much monetary stimulus as fiscal, but I don't think you're ever going to get the Germans to go along with that. They're just not going to, I don't think. But I think that Draghi can at least keep doing some form of QE, which he can do on his own in the central bank. That's probably going to go on for a while. Their economy's really gone nowhere in 6 years, and it looks like it's going to take something pretty dramatic.
Eric, thanks a lot for talking to This Week in Money.
Thanks for having me again, Jim.
And you can find out more about Eric Coffin and his service at hraadvisory.com. After the break, Tim Cyclesman Wood, next on This Week in Money.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. Welcome to This Week in Money, Tim.
Hey, Jim.
And just before we start asking Tim questions about how certain cycles are going, we'll just explain that Timers Digest has been picking you as one of the best prognosticators on what to expect.
Yeah, on gold, Jim, I get the email, and honestly, I have not even looked at it in the last month or so, but a month or so ago, I was ranked number one timer in gold. I've been one or two for quite a while now in gold with Timers Digest. So currently where it stands, I'm not real sure because, like I said, I get the email, but I haven't even looked at one recently to see where the ranking is. But yes, the statistics work.
Where are we in the commodity cycle, Tim?
Jim, commodities, talking about the cycles, the DNA markers, commodities is a good example. Back in 2008, we had a 3-year cycle that's set up with a left translated manner, set up with the DNA markers I talk about. Every market, what I do when I say DNA markers, I go back and I find all the common denominators that have occurred at these. It's a method of quantifying the cycles. And when I say the cycles, particularly the cycles tops and bottoms. Back in 2008, we had a top that occurred with the DNA markers left translated cycle, which suggested it would go below the previous 3-year cycle low. And lo and behold, commodities collapsed into the 09 low. Well, coming out of that low, the cycle was right translated. Everything was good. We saw none of the DNA markers for a left translated cycle. It didn't set up that way. And commodities rose into the 2011 high and then down into the 2012 low, which was a 3-year cycle low. But then coming out of that low, they set up with a left translated cycle top. And then back in August of this last year, I started talking about that in the newsletter. I said, we got a failed seasonal cycle. This tends to point toward a 3-year cycle top. It's left translated, just like the one back in 08. And it suggests that commodities, unless something changes real quick, that commodities are going to get weak and that we're going to move below the previous 3-year cycle low. Well, that's happened this last month. Commodities have moved below the 2012 low, just as the statistic says that it should. And that has taken a lot of other commodities down with it. Crude oil, for example. Crude oil is now back to levels not seen since 2011 and mid-2010. some of the metals. Gold has been under enormous pressure. Now, short term, intermediate term, I think gold has moved into an intermediate degree lower. It's trying to. I think crude oil is it's moved into a window for an intermediate degree low. Does it take hold here, or do we need another shorter term cycle down before the low materializes? I don't know. It's day by day. Once we get a short term buy signal in place, and then you have to look for the signs to see if it evolves into that intermediate degree low. But long story short, commodities should be at or near at least an intermediate degree bounce, but it has to develop. We talk about the statistics and the DNA markers. Equities continue to defy odds. That is the holdout. That's where the bubble is this time. And, that can't continue forever. The setup will eventually happen. The statistics will come to pass. The weight of those statistics will, eventually force those cycles down. And when it does, I think it's going to come with one heck of a snapback, and they will be fulfilled. The monkeying around with Mother Nature just can't go on forever.
We'll have more with Tim Cyclesman Wood next on This Week in Money.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking to Tim Cyclesman Wood. Tim, maybe explain to people as well that when you make your predictions on what's likely to happen with the markets, you're not watching what I call the yell and sell guys on TV when you make these predictions.
Jim, the amazing thing when I say amazing, when I stop and really think about it, it is amazing. But no, I don't even watch TV. I don't listen to the news. Because how do you know, okay, let's say, some bonehead example here, but okay, there's a drought in the Middle East, in the Midwest or whatever, and, it hadn't rained, and so that's going to make soybeans go to what price? I mean, does it matter this time, or does it not matter this time? Oh, okay, it rained, so now beans are going. Those fundamental things, yes, I know they're real, but they're really noise. They're an excuse for price movement. Okay, there's a cold front comes in, so the price of crude oil goes up. Really? That's really the reason it went up? No. It's an excuse. That's a convenient answer for why things move. It's going up because of these cycles. And if the cycle is structured to go up, it's going to continue to go up, just like the market. We've had a few cracks. It hasn't stuck. And the thing's going up because of, obviously, the manipulation and things that's going on, but the cycle they've strung the cycle out and it just hasn't turned. That's why it's going up. Commodities are going down because it did set up. We did see the DNA markers. The structure did set up. And so I look at price and the statistics and the cycles. And that's really all that matters. And when I look at the price, the statistics and the cycles, that's what scares me so much about this market. People can explain it away, but I don't care how hard you try to explain it. I know how strung out it is and what the cycles and the statistics say, and I fail to see how it can end very well. This stuff works. This is just, with equities, this is just an extreme, bubble.
Now, why wouldn't you be taking a look at current affairs to make these predictions?
Why wouldn't I? Because everything, according to even Dow theory, but technical analysis, the very basis of technical analysis is that everything is discounted into price. And so if someone thinks that the price of soybeans went up or down because of the lack of rain, or because of rain, or that crude oil went up because it's cold, or because equities went up because of one reason or another. I don't have to guess about what those reasons or how those reasons may or may not affect price. Just look at price. Price, what I'm trying to say is it's all discounted into price. Everything known to man by every market participant is discounted into that price bar. And so all we have to do is look at price and apply the statistics and the DNA markers. And like I said, a perfect example of this stuff working is what we're seeing in commodities. I mean, I talked about it back in August. It's set up just like, in accordance with the statistics and DNA markers for a left translated top, just like it did back in 2009, and we've seen the same result. It moved below. The statistic was, if it topped in that manner, then it would move below the previous 3-year cycle low. That is a 100%. If you go back in time on the CRB index, that statistic has not been there's no deviation from it. It's a 100%er. And so as strung out, what I'm saying is as strung out, going back to equities, as strung out as equities are, and as big a bubble as this is, the statistics will be fulfilled. There's no way around that.
Because humans are emotional animals, do we let our emotions overtake our ability to use rational decisions?
I think we absolutely do. I think people look at price. They look at, and I think that's what causes these cycles to stretch, is the mania and the emotion. When the emotion, builds into whatever it is. I mean, you go back into the 70s, there was an example, perfect example. I may write an article about that coming up, and maybe we can talk about it for the next interview. But there was this, back in the 70s, I believe it was, early 70s, there was this mania with sugar. And there were stories where people were, and I've got the documentation on it, where people were stealing the sugar off of the restaurant tables, and they had all these reasons that sugar was just going to continue to go up and up and up and up and up, and it had gone up something crazy. I forget, it was a crazy percent increase. I want to say it was 1,000, 1,500, 2,000% increase or something like that. This bubble with sugar, and people had all these reasons it was going to go up, and I applied, if you go back and you look at it, and I applied, as I remember, I'll look at it, maybe, like I said, do an article on it, but then once it's set up, and I applied the rules for the CRB to it, once it's set up, it was, and the statistic was fulfilled. But the cycle, yes, it was stretched into that top, absolutely, because of the emotion, the mania that it created. And that's what we're seeing here with equities, is the emotion creates the mania, and it can stretch these cycles, absolutely. But in the end, they ultimately set up, the revision to the mean comes, and the statistic is fulfilled. I mean, if you think about it, honestly, what time in history has there ever been a manipulative effort that worked long term? There's not one. It can stretch the cycles. It can draw people into the market. It can make things seem like they can, like it's a new paradigm. Things can never change, but that reversion to the mean always comes, and that's the cycle.
Tim, maybe remind folks again where they can find some ideas about your thoughts and why you feel this way.
Yes, I have it's a newsletter. I call it a research letter because that's what it is. It's research. It's evidence. It's documentation. It's statistics. And so it's more than just a newsletter. It's a research paper that I do every month, and then I had to do the short-term updates 3 nights a week in between. But it's cyclesman.com, and all the research is available there.
Tim, thanks a lot for being on This Week in Money.
Thank you.
That wraps up the show for this week. Thanks to our guests, David Morgan, Eric Coffin, and Tim Cyclesman Wood. And thank you for listening. I'm Jim Goddard. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.